29th, 2020, Maneco 64, home of alternative economics and contrarian views. Today, we're going to look at some charts of gold and silver, of the Dow. We're going to talk about what I think is going to happen in terms of the whole system going forward with what the central bankers are doing. Before I start, though, I'd like to show you something I bought on eBay the other day for £1. The shipping, by the way, was £1.30, but I think it was a really interesting item. It's a £5 silver bag from Barclays Bank Limited. There you go. So I think this is very old because the last time the UK or British coinage had any silver was in 1947. That's when they went off silver. They had 50% silver from 1920 to 1946. And before 1920, it was sterling silver, or these coins here. This is a half crown. This is a florin. And this is a shilling. So what I think this was for is you went, let's say, as a business owner, a shop owner, you went with a £5 note to Barclays Bank, and they gave you silver change so you could run your business. Or vice versa, if you had too much silver and you wanted to get a banknote, you took that back to the bank, I guess. So it just goes to show how silver has been so important to the monetary system. That silver is money. Do I think it will come back as money and currency? Who knows? Things are getting so crazy. And that's what I want to talk about today. Some of the stories that I think were significant in this last week that went by, the last week of August. Of course, Monday is the 31st of August. It's going to be a bank holiday here in the UK. I think it's also Labor Day in the US, if I'm not mistaken. Markets will be a little quieter, but the significant stories, I would say, maybe not for us because we know that this is going to keep happening. The central bankers have reassured the markets that they're going to be there. The Federal Reserve, they've come out with a new strategy that they're going to target even higher than 2% CPI, PCE, or whatever you want to call it. So I saw Ron Paul, he made a video, I think yesterday, saying mass unemployment, economy in a Great Depression or recession, and the Federal Reserve wants to create inflation, right? Doesn't make sense to those of us who know what inflation really is, how it hurts the masses. Only the very wealthy, the 1% or those just below 1%, are able to protect their wealth. They have enough assets, they earn enough fiat to convert that into real assets, while the general public, those on low wages, can barely get by. And many times they can't get by. And I think it's going to get worse because I've seen stories and videos out there talking about how credit card companies are raising their rates. Here in the UK, mortgage lenders are being much more tough on younger adults who are looking to buy their first homes. So that's not going to end. But the central bankers this week have come out and said, we're going to print as much as it takes. Andrew Bailey, he also spoke at Jackson Hole. It was a virtual conference, right? Usually they travel from everywhere around the world, the central bankers, because, of course, there's no problem for them with expenses, right? Because they create their own money and it's forced upon us. So they travel all around the world. This year, though, they've had to play with the program that we have a really huge crisis, right? And that you have to do everything virtually. So he spoke on a virtual screen. I assume he did it on Zoom. So let's look at what Andrew Bailey of the Bank of England said. So here we go. Andrew Bailey says BOE has ample firepower to support UK economy. Bank must retain ability to go big and go fast to fight future crises, governor warns. So this firepower, of course, is the printing press, or the power to create reserves out of thin air, or money out of thin air. So let's go through the article here, and I'll comment on what I think is being said, of course. So the Bank of England still has ample firepower to fight the coronavirus crisis, Governor Andrew Bailey said on Friday, arguing that the $200 billion bond buying operation the central bank unleashed in March had shown the value of going big and fast with quantitative easing, or money printing, of course. And of course, they're blaming the coronavirus for this crisis. I argue that we are at the end of this fiat currency system that's unbacked or unanchored by real money, and has been since the late 60s and early 70s. Late 60s, of course, they had to withdraw all the silver coins from circulation in the US, in Canada, in Europe, Australia, and other countries. I just had a sip of my coffee from my End the Fed mug, which you can get in the Teespring store below. There's other merchandise there as well. It helps the channel. So let's continue. Speaking at the virtual Jackson Hole Central Banking Conference, Mr. Bailey sought to refute the view that central banks, with little space to cut interest rates, lacked ammunition to fight off recession. We are not out of firepower by any means, and to be honest, it looks from today's vantage point that we were too cautious about our remaining firepower pre-COVID, he said, while noting that the choice of two to use is more important than it has been at times in the past. The BOE believes the kind of aggressive bond buying operation it launched in March, both larger and faster paced than previous rounds following the banking crisis and the Brexit referendum, shows that going big and fast with QE works best at times when markets are seizing up with financial stress threatening to damage the economy. Well, the reason he had to go bigger and faster is that all these crises are getting bigger and bigger. And the Bank of England and other central banks, they need to print or create even more reserves, or money, if you want to call it. So my view is that in the next crisis or next market crash that many out there are calling, many cycles analysts are calling for a big drop soon. It will be even bigger, people. And yes, gold and silver might correct a little bit when that crash happens. But when they come out with big and fast, big and faster, as Andrew Bailey says, gold and silver are going to react even more aggressively to the upside. People are going to start to realize, even the people who have bought into this system of money, that the creation is really easy and there's no consequence. They're going to start realizing that, wait a second, what's going on here? Can they really keep doing this, creating all this money out of thin air? Money, in the end of the day, needs to represent effort, work, resources. It can't just be created by someone typing on a computer, right? How the central bankers do. The central bank took the emergency decision in March to pump money into the government bond market when it saw gilt yields start to fluctuate wildly. Well, that's just a euphemism for losing control of that market. I think people were liquidating even government bonds. Interest rates were going to spike higher, just like they did during the European sovereign debt crisis. So that's what he's talking about here. Threatening a breakdown of the core of the UK's financial system, the BOE has also helped the government fund a massive expansion of public spending to tackle the crisis by agreeing to directly finance the state's needs on a temporary basis. Well, I'm not sure it's going to be temporary. It's the Ways and Means account. So what they're doing here is they're printing money and giving it directly to the government. Usually the government has to borrow the money in the markets, issuing gilts, and then the investors will buy that and then quickly sell it to the Bank of England, who's doing QE, right? That's the only reason why investors are still buying gilts, is because the Bank of England has become the buyer of last resort. So I'm not going to go through the rest of this article, but it just goes to show you the mindset for the central bankers. And they've confirmed it this week. So now let's look at some charts, some longer term charts. So let's start with the Dow chart, actually. And I'm going to take you back 100 years. So is the Dow chart going back to 1920. It is a logarithmic chart. So let's have a look at that. So here's the Dow chart going back to 1929. It is a logarithmic chart. So the all-time high there was 386.10. Then we had the initial crash into November 1929. Then we had a rebound into the spring of 1930. And then the final drop into July 1932. So it took about 2.5 years for the market, almost 3 years for the market to finally bottomed. It bottomed just above 40, so it was a drop of just under 90%, around 89%. The other interesting thing about this crash is that the bear market really only ended in 1954, in November of 1954. That's when the Dow again closed above 386. So it took 25 years for the market to recoup. I think that's a dire warning, or a very serious warning for those who think that buying stocks will always result, the buy and hold strategy. We need to be careful. I've been talking about how there's a lot of resistance at this trend line at the top here. And as you can see, it does have quite a bit of resistance. Earlier this year, the all-time high was 29,568. Right now, we're at about 1,000 points below there, 900 points. Will we make a new high? It's possible. I personally think it's going to be tough, even though, of course, the NASDAQ and the S&P have made new all-time highs recently. But as many people and technicians have said, a lot of these gains are because of a few stocks that have done really well. The broader, if you take those bigger stocks like Microsoft, Apple, Tesla, kind of like the FANG stocks, of course, the indices haven't done as well. So I thought this was really interesting to look at this chart. Yes, we could continue to go higher. We could see a big correction down. We could see the central bankers come back and try to reinflate it. It's going to be interesting. I mean, a lot of the cycles people are talking of a bottom maybe in the next 12 to 18 months towards 2021, 2022. Some people are talking about a 5,000 Dow. I mean, that would be a huge drop, of course. You can see this trend line here. Right now, we've got 7,300 is the bottom of this trend line. And as we go further along in time, it rises. So a break of that trend line would be very serious. And I think the central bankers would keep trying to inflate. And by that, I mean even more money printing. Of course, they can't cut rates much further, or they could go into negative. Andrew Bailey is saying that negative rates is in the toolkit, but they're not thinking about it yet. I think they're just holding on to that. Same thing with the Federal Reserve. And it's questionable whether it would work. All the new stimulus, potential stimulus that they could bring in because of a crash. Because as you see here in 1932, when we bought them there, FDR came to power in early 1933, March 33. He started all these new programs, New Deal. He confiscated gold and then devalued the dollar versus gold from $20.67 an ounce to $35. And all he got was a rally up to around 200 in the Dow. Didn't even go back up to the previous all-time high. So it's not etched in stone that if the central bankers come back with even more firepower, as Andrew Bailey calls it, that they will be able to bring the market back up and to make new highs. So, and I think there would be a big loss of confidence in central banks. And whenever that happens, gold and silver do very well. It doesn't necessarily mean that gold and silver will go down either, because what it's going to show is that the central bankers created all this phony money for naught, and people are going to lose confidence in it if this money is not creating even more artificial wealth like in the stock market. So they're going to turn to precious metals. When Harry Dent talks about deflation, I think he's right. I think the thing he gets wrong is that in a deflationary collapse, people go to gold because a lot of companies, a lot of governments, a lot of institutions, local governments, states go bankrupt, and people want to be in the safety of money. And don't forget, money is gold and silver, and that's where people were trying to go into in 1933, and that's why FDR had to close the banks, institute the bank holiday, because the people were rightfully demanding their money, gold and silver, from the banks, and they didn't have enough. They'd abused the system, right? They printed too much reserves or money out of thin air, and it's the same thing that's happening here, even though we're not in a de facto gold standard. And with that, let's go have a look at the charts of gold and silver. So I'm going to start with the silver here, as you can see, and it's going back to the early 70s. That's a logarithmic chart as well. And now you can see why the $50 level is so important, because we had a top in 1980, of course, around 48, the Hunt brothers spike. And one thing about the Hunt brothers, many people don't know, their father was a very rich oil businessman from Texas. And they started buying silver actually back in 1971. After Nixon closed the gold window, they realized that the dollar was not going to be worth much. So they couldn't buy gold back then because it was against the law in the US to buy gold. So they bought silver. So it wasn't just an affair where they came in maybe in 1980 and tried to corner the market. No, they had actually been using the futures market to buy physical gold. They were taking a lot of delivery throughout the 70s. So just wanted to put that out there. So one key level this year, of course, was the 21 level, which had been the high, as you can see here, in July of 2016. But it was also a very important high in March of 08. And that's why silver really took off once it broke that 21, I think it was 2120, 2115 level. And as you can see, this is a monthly chart. So it feels like silver hasn't done well recently, but it's actually closed at a new monthly high, as you can see here. And 30, of course, is going to be a key level right now for silver. So now I wanted to show you a shorter term chart of silver. It's a weekly chart. And you can see here how silver is consolidating. We're forming kind of like a triangle or pennant. And yeah, we're getting close to the apex of that pennant or triangle. And I think we could see a breakout to the upside in silver. And where could the target be? Well, I would say maybe 42. Why 42? How does that work? Well, if you see the move in silver here, it started out really the big move higher in the beginning of July around 18, and we went, it took about a month to get up to 30, right? And it's consolidated here in the pennant. And usually when we break out on the top side of the pennant here, which right now is around 28 or 29, let's say, but more like 28, we could see the same move that we saw in the previous move higher from 18 to 30. So that's $12. So you add that to 30, which is the previous high, and you get 42. Again, these are just probabilities. It's not a certainty. It could be a little lower. It could be a little higher. Now I'm going to show you some more charts of gold. This, of course, is the monthly chart. I've been speaking about how closing above 1825 was so important because that was the closing level back in July of 2011. We did that in July this year. August, of course, we closed above 1825, so it's breaking out still. Yes, we closed slightly lower in the month, as you can see there. The other thing I wanted to point out, and I'm going to draw it for you right now. If you look at the Fibonacci retracement of the price move just this month, let's see here. Let's get this straight. The high this month, the low this month. Yes, it looks a bit messy, but as you can see here, the 50% retracement is 1969, and we closed around that level, right? 1965, 64. Yesterday, we did get above that level, but there's a bit of resistance there. So that's why I think we settled around there. The 50% retracement of the move, of the range of the month. Sometimes markets tend to hover around that 50% retracement. So now let's look at a weekly chart. Let's change this to weekly, see how it looks on the weekly chart. I'm going to draw a trend line that's quite interesting here for you as well. From the low in March, when we saw gold get hit with the rest of other markets, right? And you can see that trend line here. It's held up quite well. And we've also got like a pennant or triangle here. I'll draw it for you quickly. You can see here, there's the top side of it. Let's draw the bottom of it. There you go. So next week, as you can see, that's coming in at around 1973, 1975. So that's the level to look at. Of course, on the downside, I would say if we break through 1900, yeah, that's a key level, support level. We'll have to wait and see. Seasonally, of course, gold and silver have a very good month in September. So it's looking pretty good for the precious metals. Yesterday, of course, I did a video on the dollar index. I'll put it up in the cards. You can watch that. Dollar index not looking very good. To finish off, let's look at the long-term chart of gold. It is a logarithmic chart going back to the early 70s. The low there in August of 1970 was around 35.50. That's where I drew that trend line from. And then the top trend line, we got the high in January 1980 at 8.50. And then we've got the high in September of 2011 at 1920. So you can see from this chart as well that there's still a lot of room on the upside in gold in percentage terms. And I've spoken about the top trend line here. And I've spoken about the top trend line there in gold. And as you can see here, it comes in just above 2,400. So if we break above 2,400 in the next few months in gold, it will be very positive. And what would that mean in terms of the overall picture for the markets, not only precious metals, but for the stock market? I think gold and silver are in the long-term bull market. We've broken through some key levels in gold, as you've seen. We've closed 2 months above 1825. Of course, silver is still below that key 50 level, but I think it could get there very quickly. The stock markets are near or at all-time highs, of course. The fall, of course, or autumn is always a tough time for the stock markets. Are we going to get a crash like many see? A lot of cycles analysts like Michael Oliver, Charles Nenner, even Harry Dent, they see big drops in the stock market. Is it going to happen in a matter of weeks like we saw back in February and March? I guess it could be a bit more protracted. And as you saw earlier from the chart of the Dow back in 32, when FDR came in 33, he threw a lot at the economy, didn't he? He started the New Deal, all the programs, all the government spending. He devalued the dollar, and we saw that the Dow didn't get back up to the all-time high. It got up to like 200 or 196, and it took 25 years for the Dow to actually make a new all-time high. So what I'm trying to say here, yes, it's possible that we get a hyperinflationary event, but it's also possible that the stock market kind of remains in limbo after a correction, and that the precious metals keep going higher. And that's how I see things. I don't think things keep going on forever. There are always cycles. And I think the next big cycle is going to be away from financial assets. Is it going to take another 25 years to see an all-time high in the stock markets, in the Dow or S&P, after a potential crash in the next year or two? It's difficult to say. It could take less, it could take more. But all I think is going to happen is that people are going to move from one side of the boat to the other. We've been too much focused on financialization, on borrowing, on leverage, on paper assets. And I think the world is going to move more towards real things. And that's why the stock market is going to have a tough time, in my opinion. All I'm trying to say is that things could get very different from what we've seen in the last 20, 30 years. Buy and hold might not be the greatest strategy going forward. And you need to work out yourself what you need to do to preserve your wealth. Of course, I think holding precious metals is a very good strategy. It's not an investment, but when the fiat currencies are collapsing as they are, and if we get a deflationary collapse, or if we get a hyperinflationary event, precious metals will do well either way. There you go. That's how I see things. I don't see the central bankers changing anything. I don't see the economies, of course, getting any better. If anything, things are going to get worse, I think, from September and October onwards. And I see that politically is getting tougher for people, politicians, not only in the US, but everywhere around the world, to agree on extra stimulus. And there comes a point as well that if the economy is in a recession or a Great Depression, you can pump as much funny money into it. All it does is begin a process of loss of confidence in the currency. If you go back to all the hyperinflations in 1790s France, in 1920s Germany, in Venezuela, in Zimbabwe, the major characteristics of those hyperinflations were political turmoil, which we starting to have, and economic weakness. Is not based on economic growth, stability, and demand. Hyperinflation. So keep that in mind. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter and Facebook. I wish you all a great weekend. And don't forget that tomorrow I have my live stream tomorrow night at 9 p.m. London time, 4 p.m. Eastern time.